The economy just threaded the needle everyone said was impossible. The January jobs report beat expectations. Inflation came in cooler than expected. The soft landing is real. So why isn't everyone celebrating? Hi everyone, I'm Christos, co-founder of Caplytica. Today, we're breaking down why this week's economic data looks like a win, but comes with some serious caveats. Listen, there's one signal buried in the bond market this week that directly contradicts that soft landing narrative, and it might be a more honest read on where the economy is actually headed. I'll explain in a few minutes. Let's get into it. The numbers look almost too good. January added 130,000 jobs. Employment dropped to 4.3%, and the CPI reading came in cooler than anyone expected. This is the combination economists have been chasing for 2 years. Inflation moving towards that 2% target without breaking the economy. The soft landing that seemed like wishful thinking 6 months ago now has real data behind it. But here's what caught my attention. Despite all this positive news, the S&P 500 still can't close above 7,000. The index keeps approaching that level and falling off, with intraday volatility hitting historic levels. If the data really is this good, why isn't the market responding? Part of that answer is in the bond market. Treasury yields moved in ways this week that suggest fixed income investors are not buying that optimistic narrative. They're pricing in slower growth and a lower path for rates, which actually sounds bullish until you realize it implies they see economic weakness that the jobs report doesn't capture. December retail sales came in flat, adding weight to that skepticism. Bond traders often see around corners that equity investors miss, and right now they're more cautious than the headlines suggest that they should be. The soft landing could be real, but 1 or 2 months of good data doesn't establish a trend. The economy is navigating multiple cross currents, and one of the biggest is creating clear divergence in corporate performance right now. Pinterest stock dropped 17% last week, not because they missed earnings, but because their CEO revealed that major retailers that are impacted by tariffs are slashing advertising budgets. That's a company getting hit by a problem that doesn't even show up on their own balance sheet. Meanwhile, Ford just reported its worst quarterly earnings miss in 4 years, and Mattel struggled through a tariff-marred holiday season. The pattern is becoming impossible to ignore. What makes this particularly tricky is the damage isn't uniform. Chinese factories are buzzing with activity a year into the tariff regime, suggesting supply chains have found workarounds. Some companies have adapted, others are absorbing costs that compress margins quarter after quarter. For investors holding positions in consumer discretionary or companies with complex international supply chains, this creates a real question about conviction. These stocks face strong structural headwinds that macro data won't solve. A Supreme Court ruling on tariff legality could come as early as next week, but even if tariffs get struck down, President Trump has already signaled he's going to pursue alternatives. Policy uncertainty is not going away anytime soon. This bifurcation means that sector selection matters more than riding broad market momentum. And speaking of momentum, another company beat expectations and still got punished anyways. Cisco reported earnings last week that beat both revenue and profit estimates. If you're wondering how a positive earnings report triggers a sell-off, welcome to the expectations game. The issue isn't Cisco specifically, it's what the reaction reveals about the current environment. When stocks are trading near record levels, investors are not just buying what a company did last quarter. They're buying what they expect over the next several quarters. Cisco's guidance was described as mediocre, and mediocre doesn't cut it when the price already assumes exceptional. This dynamic matters beyond one stock. Technology has led the market recovery, and many tech names now carry valuations that require continued acceleration to justify current prices. The market is actively differentiating within tech, drawing lines between companies it sees as AI native and companies it views as potentially disrupted. It means that the margin for disappointment is razor thin. When winners dominate a portfolio, modest disappointments create outsized damage. The Cisco reaction is a reminder that expectations can run ahead of fundamentals, and when they do, even good news becomes a selling opportunity. What we're really watching unfold here is the market trying to reconcile competing signals. The economic data looks encouraging, but bond markets aren't fully convinced. Tariff policies are creating pockets of stress, while valuations assume things keep getting better. None of these resolve cleanly into a single narrative, which is probably why volatility has been so elevated despite the positive headlines. The soft landing may be real. It might also be more fragile than the data suggests. What matters for anyone building wealth over time is not getting the next 3 months exactly right. It's understanding the environment well enough to avoid costly mistakes when sentiment shifts. That kind of clarity starts with knowing your risk tolerance, which is something I built the tool for. If you haven't taken our risk tolerance quiz yet, this video walks you through exactly how to use it and why it matters more than most investors realize.